Good morning, everyone. We're just going to give one more minute to allow others to join, and then we'll begin our webinar. Once again, good morning and welcome to the Now What? Post-election end-of-year tax strategies webinar. I'm Juliet Greco with the Catholic Foundation of North Georgia. If we could just take one moment and just start with a Hail Mary. So in the name of the Father, Son. Hail Mary, full of grace, the Lord is with thee. Blessed art thou among women, and blessed is the fruit of thy womb, Jesus. Holy Mary, Mother of God, pray for our sinners, now at the hour of our death. Amen. The Catholic Foundation of North Georgia helps Catholics make a lasting difference in our community. We attract, professionally manage, and invest gifts to support the current and long-term financial needs of parishes, schools, charities, and other ministries. The Catholic Foundation is a trusted partner of parishes, schools, ministries, and nonprofits in the Archdiocese of Atlanta. We work closely with individual Catholics who wish to make a real difference in our Catholic community and leave a legacy to support causes that they care most about. Although our services are professional in nature, we truly see our work as a ministry. Our service is inspired by our mission and vision. So today's webinar is part of a series of events hosted by the Catholic Foundation for our Professional Advisors Network. We partner with our professional advisors to work with the individuals, with the schools, parishes, and organizations. So what is the Catholic Foundation Professional Advisors Network? The Catholic Foundation Professional Advisors Network brings together estate planning attorneys, accountants, financial planners, wealth managers, insurance advisors to promote collaboration, education, and leadership in current and legacy giving among their Catholic clients. Before I introduce our speakers, just some housekeeping tips. We will keep everyone muted during the webinar, but we welcome you to please use chat feature at the bottom of the screen. If you hover your you can find the chat at the very bottom, and please submit your questions. We are very grateful for our panelists for their time and their expertise. Alan Connor is Nova Point Capital's president. He also serves as the firm's chief compliance officer and fixed income portfolio manager. Alan has over 25 years of experience in the investment management industry. Prior to founding Nova Point, he was a fixed income manager at both Spectrum Advisory Services and a private family office. Alan also worked in the bank group division of county-wide capital markets, where he developed strategies for depository institutions. He earned his BS in Banking and Finance and MBA in Finance from Nova Southeastern University. Alan is an endurance athlete and three-time Ironman finisher. He is a board member of Positive Growth, an organization that improves the lives of children, young adults, and families during difficult life transitions by providing residential and community-based treatment services. Saber Linehan joined Smith & Howard in 2002 and is a partner in the tax department. She works with many of the firm's nonprofit clients, including performing technical reviews of their Form 990, providing guidance on ways to build the 990 into a more effective marketing tool, and planning and consulting with clients as their businesses change and grow. Her experience also includes working with a broad spectrum of privately held middle market businesses. Sabre, who has a Bachelor of Masters of Taxation degrees from Georgia State University, is a sought-after speaker on the Tax Cuts and Jobs Act of 2017, as well as its updates, and has presented to many groups on the topic. She is a regular attendee of the American Institute of Certified Public Accountants nonprofit conference. Sabre has been a speaker at the Georgia Society of Certified Public Accountants nonprofit conference and at the Southeastern Accounting Show. She attends Buckhead Church, where she is lead teacher, and Womba Land, serves on the board of the Center for Family Resources, and is the current chair of the Finance Committee. Brent Herron is the managing partner in the law firm Small Herron LLP, where he divides his practice between transactional and litigation matters. His transactional practice is concentrated in the areas of estate planning, wealth preservation, corporate, and tax. His litigation practice is concentrated in fiduciary and commercial litigation, bankruptcy law, and creditors' rights matters. Brent received his Bachelor of Business Administration in Banking and Finance from the University of Georgia. He obtained his Juris Doctor from Samford University's Cumberland School of Law and his Master of Laws in Taxation from the University of Alabama. Thank you all, and I will now turn it over to Brent.
Thank you, Juliet. Glad to be here this morning. I hope everyone is doing well in this season of Advent as we prepare for Christmas. So what now? After the election, we all thought the election would be over by now, and that we would be moving on and we would know exactly what is going to happen. But unfortunately, the two Senate races here in Georgia didn't turn out that way. So we have two runoff races here in Georgia that will determine the political control of the United States Senate. What we all wanted for Christmas, I'm sure, was unending political commercials on television through the Christmas season, which is what we're going to have. But you know, what are we looking at in those two races, and can we believe the polling data that is out? I just checked the latest polls yesterday. Depending on which poll you see, the Republicans are going to win in some, the Democrats are going to win in others. You average them all together, and it shows that the races are statistically tied. So what does that mean for tax policy going forward? And we really don't have any concrete insight into that, and won't have it until after the new year. However, obviously, if the two Republican candidates here in Georgia were to win, we would not expect too much change in tax policy over the next 2 years, as Republicans would control the upper chamber. If the Democrats win both of those seats, obviously there would be a 50-50 split Senate, and Vice President Harris would have the tie-breaking authority over any sort of party line votes that come out of the Senate. However, you know, there are two senators, Democratic senators, people should be watching if that were to happen, and that is Senators Joe Manchin of West Virginia and Kristen Sinema out of Arizona. Both of those senators are not likely to be in favor of large tax bills coming through the Senate, especially on the income tax side. We might see some movement on the estate tax front if the Democrats maintain control of the chamber, but I doubt that we will see much on the income tax side, maybe a little bit around the edges. But that's kind of where we are. We don't know what to expect, but we do have some, I want to talk a few minutes about what, if the Democrats were to take control of the chamber, what has been proposed by the Biden administration. They have proposed that they will increase the top marginal tax rate from 37% back to 39.6%, which was the top marginal tax rate for income taxes before the 2017 Tax Act. They have also said that any tax increases, income tax increases, would only affect incomes for individuals that are in excess of $400,000. They have proposed to phase out the 20% pass-through deduction for incomes over $400,000, and that is the deduction that those individuals that receive income through partnerships, LLCs, and S corps are allowed to deduct 20% of the pass-through portion of that income on their tax returns, and that was put in to the 2017 Tax Act to try to give some parity for the lowered corporate income tax rate for these businesses that are not taxed as corporations but have pass-through income. There is a discussion of modifying the wage base for Social Security tax. And what the proposal is that basically there would be a donut hole, if you will, of no tax for Social Security. So you would have tax from $0 up to next year, the wage base will be $144,000. So you'll have from 144 up to 400, you would not be paying Social Security tax, but once you surpassed the $400,000 mark, there would be a 12.4% payroll tax imposed on any incomes above 400,000. They have also discussed increasing the corporate tax rate from 21% up to 28%. They have proposed eliminating the preferential treatment of capital gains rates for incomes above $1 million. Right now, there is a graduated scale that you pay on capital gains that ranges from 0% to 20%, depending on your income. But there would be an elimination of that rate for any incomes above $1 million. So you would pay at the top marginal tax rate for capital gains above that amount. The estate and gift tax exemption is likely to go back to at least $5 million, potentially back to $3.5 million, and indexed with that $3.5 million indexed for inflation from 2009. That's the $3.5 million exemption dates back to 2009, and the proposal would be that we would index that for inflation. The estate and gift tax, the portability portion of estate and gift tax, where one spouse were to die and not use all of their exemption and can be given to the other spouse, that is unlikely to go away in any of these proposals. They have also proposed eliminating the stepped up basis at death, and that is where there is an asset that has appreciated over time that the decedent has in their estate that is revalued for basis purposes to its current market value at death. There has been talk of eliminating that. That would have for family-owned businesses and family farmers. That's usually who you see senators talking about, who this would hurt the most. It would hurt them in the sense that you would have to liquidate some of those assets in order to pay the tax at the decedent's death. So there's been a lot of talk of that over the years. I'm not really sure whether or not that actually would make it through a piece of legislation. The one question I keep getting is, what is the timing? What are the timing of these potential changes if they were to go into place? And the law is pretty clear that tax changes can be retroactive to the same tax year that they are passed. Usually they are tied to the date any legislation is introduced, that they would be effective as of the introduction date of the legislation. So I would anticipate that on January 3rd, when a new Congress is sworn in, we will probably see some actual legislative language on some of the stuff that will be proposed in the event that the two Senate races here in Georgia are picked up by the Democrats. But most of the time we see with tax legislation, to the extent it's a tax increase, it will be it will not be retroactive, it will be effective, usually up to the next tax year. So that is historically what we have seen in the past, and I would think that's probably what we will see again. So I doubt, even with these proposals, that a lot of this stuff will actually happen in 2022 as far as being effective for the whole year, but that remains to be seen. So what should you consider doing now with these potential proposals? One thing is to accelerate income, certainly income that is guaranteed. If you could accelerate it into this tax year, that might be a good idea. Delaying deductions to the extent you can delay deductions and push those into the next tax year. We were talking yesterday. I have a client right now I'm negotiating an employment contract for who has some significant guaranteed bonuses that are to be paid within 30 days of the execution of the contract. And right now we're trying to negotiate to get that paid into this tax year, so it's paid by 12/31, because of the concerns that if these tax policies go into place, that there will be a significant or several percentage point increase in taxes. And if you're going to pay tax on the money anyway, no matter which year you take it in, it's better to go ahead and take it at the lower rate now. I've talked to a number of clients about accelerating capital gains, especially high net worth or high income clients that I have who are discussing accelerating their capital gains to lock in the current rates. And I've had a number of clients over the last few weeks that I've had discussions with about setting up charitable trust. So those are three things that I've been talking with clients about over the last few weeks from an income tax perspective. From an estate and gift tax perspective, I've had some discussions with clients about using the higher exemption because if the estate and gift tax proposals go into effect, the exemptions that are out there will be significantly reduced. And there is a Treasury regulation that says, if you give away more than whatever the exemption is, there's not going to be a clawback of that amount. So right now, the current exemption for a married couple is around $23 million in estate tax before you have to pay estate tax. So most of the people that I've been talking with who are considering making gifts to take advantage of that exemption are people that are individuals that are in the $10 to $20 million range, who can give away a significant amount of wealth, but yet still hold a certain amount of wealth because they don't want to give it all away. And really that question comes down to how much can they comfortably give away to their family members and still maintain enough for their lifestyle. The use of grats has also been a popular item of discussion. Grats have been on the IRS list of potential strategies to try to limit. Several years or many years ago, the Walton family set up what was known as the 2-year rolling grat. Walton family of Walmart fame. It was the 2-year rolling grat where every 2 years it just kept rolling over and over and over. And they were able to transfer a significant amount of wealth to lower generations of that family. And the IRS has consistently tried to attack those. And so the proposals have been to make either a 10-year minimum term for grats. Seems to be the most popular item that people are discussing. As well as there was just a recent proposal that was put out by Larry Summers and a former commissioner of the Internal Revenue Service, and his name escapes me right now, but their proposal was to make grats a listed transaction that would have to be disclosed to the Internal Revenue Service, which of course would give them an opportunity to come back and audit those returns with more vigor. Another thing that I've been talking with clients about, especially some older clients, are charitable gift annuities. The Catholic Foundation does have this as a giving option. They're good for individuals who are looking for a stream of income over a period of time and a charitable deduction. In essence, what the individual will do is they will transfer either cash or other property to the Catholic Foundation, and the Catholic Foundation will pay them a fixed stream of payments for their life. And those payments, the payment depends obviously on the age and when the payout starts, because it's paid out over the life expectancy of the individual. And you don't have to pay out right away. You could do a deferred charitable gift annuity. It is an option. But you do receive the charitable income tax deduction on the gift portion of the annuity immediately. So it is a good option for those people that are looking for a stream of income over a period of time and are looking for an immediate tax deduction. I've also been talking to a number of clients about setting up donor-advised funds. The Catholic Foundation does sponsor donor-advised funds and establish donor-advised funds for their clients. You get an immediate tax deduction for amounts that are given to the fund. You could have capital gains savings if you contribute appreciated securities. So if you have securities that you would otherwise be paying capital gains tax on, if you liquidated those securities and gave the cash over, if you donated the securities instead, you save that, because if the Catholic Foundation liquidates those securities, they do not pay tax on that as a nonprofit. Also, you could also donate unique assets. I know the Catholic Foundation in other funds has taken coin collections, gold bullion, things like that, unique assets that clients might have that might be beneficial. The donor-advised funds are invested professionally by the Catholic Foundation, and the investments are in accordance with the United States Conference of Catholic Bishops' Socially Responsible Investment Guidelines, which for those of you that were unable to attend our conference back in January, there was a great presentation actually on the socially responsible investment. And we would be happy, if you have any questions about that, to get you more information about that. Any funds that you donate to the fund would grow tax-free for future grants to the charities of your choice. But we do ask that those charities be for donations to be given to charities that are in accordance with Catholic teaching. You get the like I said, you get those donations over time. You can make those donations over time. So a lot of times I've seen this with clients who get a large bonus or a large amount of income in one particular year, and they're looking to make to donate a significant portion of that, but they don't want to do it all at one time. They want to do it over a period of time. Donor-advised funds is a perfect solution for that type of client. With that, I'm going to turn it over to Sabra to talk about a couple of other items.
Thanks, Brent. Good morning, everyone. You know, it's hard to believe that about 3 years ago we were in a similar position on the tax side, looking at changes in tax law and what that would mean for our clients. 3 years ago, this time we were getting introduced to new ideas for tax law, and we saw tax reform pass very quickly in December of 2017, and it became effective for January of 2018. And that changed some of the way that we're doing planning for our clients because of those changes. On the individual side, the words we kept hearing were simplify tax compliance, make it easier for individuals to be able to file their annual returns. The largest impact on that side was the change in the standard deduction for individuals. For married couples, that amount is about $25,000 now. That's double what the old limits were. And what that has meant is that when you look at the higher standard deduction and some of the changes to other types of deduction, it makes more sense for millions of Americans to just take the standard deduction, file their returns a little bit easier. So then looking at, for those who continue to itemize, under the current tax law, we've got some new limitations. things like taxes that were deductible on your federal return. Now those are capped at $10,000, and that's capped for the total of your state income taxes, your property taxes, any ad valorem taxes. Anything you pay in excess of $10,000 is just not deductible anymore. There are also some limitations on mortgage interest deductions for new mortgages that were initiated about 3 years ago. And so when you look at all that and what that meant, really the only play that we were left with on itemized deduction planning was the charitable contribution. And so for individuals who wanted to try to get their income tax down, try to find some more deductions, the bucket is now charitable contributions. And the limitation there got a little more favorable for individuals. For cash contributions, that limitation was 60%, which was an increase from prior limits. So it gave us more to work with. But then overall, individuals were looking at, what can they do to take advantage of the simplification and the higher standard deduction, but also get some benefits for support to organizations through the itemized deduction. So we've seen more charitable giving bunching, where you have individuals who want to continue making gifts to organizations they support. And so what they'll do is they'll figure the total for 2 to 3 years of giving. They'll give that total all in 1 year, take the itemized deduction that year, and for the next year or two, not give quite as much because they've got that standard deduction to reduce their income. And so that's been something that we've seen a little bit more of. But then when we came to 2020, we saw some changes again through the CARES Act. And we've all heard about a lot of the various provisions. One of the probably the most familiar ones are the paycheck protection loans that were out. But they also made some changes to charitable giving, because what the nonprofit sector saw is a lot of pressure and an increased demand for services. And so the government has made it more attractive for individuals to support nonprofits. For 2020, cash contributions are deductible up to 100% of your adjusted gross income. So we went from 60% to 100%. This is for cash donations, so it doesn't apply to stock or other property that someone may be gifting. And it's for charitable deductions to public charities, your 501c3s, not applicable to donor-advised funds. And public charities means that any gifts to private foundations do not fall under these limits. If you've got individuals who are giving a combination of cash and non-cash property, there's still some planning to be done because those non-cash limits are still in place. But this does give a lot of opportunity, especially for individuals who have high income years, very charitably inclined, and can afford to do so. This is a great benefit both on the individual side and for the nonprofits who are doing some additional work this year because of the pandemic. And another thing that we see a good bit of, not so much this year, are the qualified charitable distributions. So individuals who have IRA accounts, when they reach an age threshold, it was 70 and a half before recent law changes to make it 72. But those with a traditional IRA are required to take minimum distributions each year. And those distributions are calculated based on the account value and the life expectancy of the individual. You're required to take those. They come out as income. You pay tax on it. If you don't take the required amount each year, then there is a penalty assessed, a pretty steep penalty for the difference in what you take and what you should have. The qualified charitable distribution allows an individual to direct that required amount up to $100,000, direct that to a 501c3 charity. And it accomplishes a couple of goals. It counts for your required distribution, so you get out of that penalty on not taking the money. You support an organization. And then when you combine a lot of the other tax changes we've had, like an increased standard deduction, this is a lot of times is a better option for some individuals. So we see a lot with clients who they don't need the distribution from their IRA to live. They have other assets and other income, so they don't need the money. Or they're filing using the standard deduction and wouldn't get a deduction for any gifts to charity anyway. And so what they can do here is they can take a charitable distribution. It goes directly to charity, counts as their required distribution. It is not included in their taxable income, and they've still got a large standard deduction. So it accomplishes a lot of different things and gets people into a better tax position, and also accomplishes that goal of philanthropy that they have. Now, we haven't seen as much of this in 2020 because the CARES Act suspended the required minimum distribution requirements, but we have seen clients continue to do it if it's part of an overall estate plan, or they want to continue giving during the year. At this point, there's no waiver on the required minimum distributions for 2021. Gotten that question a good bit, but I expect we'll see some sort of additional relief packages, so there may be some more planning that can be done into 2021. And I'll turn it to Alan to talk about a few more things.
Thank you, Sabra. I'm going to touch on kind of three topics. One is taxable assets, non-taxable assets, IRA accounts, and the use of insurance when it comes to charitable giving. Probably one of the things that we see more often than anything is clients donating appreciated stock from their various investment accounts. One thing to keep in mind, this being the 10th of December, is that this is a transaction that has to be done and completed by December 31 in order to get the tax deduction for this year. We have been seeing some notes from custodians that we work with that some of the backlog is starting to happen. So this is something that if you have a client that's thinking about it, it's not something that you want to try to push through the gears of custodians on the 31st of December. So I would certainly encourage people to look at that early and so forth. So why do you give appreciated stock? First and foremost, the first two topics that I'll talk about, it reduces the value of your estate. But more importantly, and Brent touched on this earlier, is that you get to give the full value of the stock rather than the after-tax value. While we have had volatile markets this year, the markets are up from where they were in January. So people have appreciation in various stock positions. Donate the shares of stock rather than liquidating it, paying a capital gains tax, and then donating the residual to a charity. We also see clients do this. They ask us this on a pretty regular basis of whether or not they have a position that they've done very, very well in. As much as people hate to reduce the size of a position that they've made quite a bit of money in, it's also something that you can utilize to rebalance your portfolio. If somebody has a position in stock that they've done pretty well in over the years, give some of this away, reduce it, and maybe reduce some of that individual stock risk that you have. Also, when it comes to making your charitable gifts, Sabra touched on the topic of bunching donations in order to qualify for the charitable donation for tax purposes. This is something where you could donate a larger position of a security, make yourself eligible for the deduction under kind of bunching your contributions, and become eligible that way. for that deduction. So that's kind of where we've seen on the taxable side of accounts. When it comes to IRA accounts, correct me if I'm wrong, Saber, was it the Secure Act earlier this year that changed the requirements for RMDs? It extended them out to, I think, age 72.
It was secure.
It was, okay. So with that, and I think Saber touched on it, that we haven't seen with the waiver of required minimum distributions from IRA accounts in 2020, haven't seen much of that. But an easy donation that you can request of a client who might be charitably inclined is, once again, it's a tool to reduce the value of their estate, but it's also something that it's non-cash at this moment in time. So, we have clients that have changed their beneficiaries from children to, whether it be a donor-advised fund or whether it be a specific public charity or whatnot. We see that, the charity can make a distribution after someone passes. There are no taxes to pay at that particular point in time. Charity's tax exempt, not a problem there from that concept, as well as reducing the value of the estate. And then we've also seen clients that have named charitable remainder trusts as kind of a generation skipping. That's more of the technical perspective of that is more so to Brent. It is kind of funny that, we just came through the Thanksgiving holiday, and we also came through an election period that was a bit contentious. So we've seen a couple of clients that have disinherited relatives and added charities to their IRAs rather than family members. So, you can keep that in mind, and it's also a topic for a little bit of humor when it comes to that. Lastly, I'd like to touch on charitable giving with insurance. It's not something that we see on a frequent basis, but it is something that comes up, especially when people serve on charitable boards. Someone that may already have an insurance policy, whether they thought that they needed it to cover estate taxes or some other item, depending on what else is going on within somebody's estate. Somebody could actually change a beneficiary or make a partial beneficiary of an insurance policy a charity. This does, a couple of things. One, it leverages the cash donations that somebody might make to a charity, where, if someone were to, let's just say making a dollar donation every year to a charity, maybe add a little bit to that and add an insurance policy with those proceeds. That's a nice thing to, maybe it's a, $5,000, $10,000, even, maybe upwards of, $100,000, $500,000 insurance policy, depending on premium cost. Someone can actually, establish an endowment in your own name or your family name for a charitable organization as a means of leveraging those dollars. So it's an easy thing. Somebody's not writing a large check to a charity today and getting the benefit going forward. So an excellent way to consider leaving a legacy. That's all I've got. I'll turn it back to you, Brent.
Thanks, Alan. Julia, do we have any questions from any of the participants?
We do not have any questions at this time. Again, we welcome you all to please submit your questions on the Zoom group chat.
One comment I would offer, Alan, I've seen that same issue about wanting to disinherit family members. And speaking of charity, I always try to say we should just be more charitable. Maybe we should be more charitable to our family members sometimes than we are. So, but I certainly have had a number of conversations with clients on both sides of the political aisle on that over the last 30 days.
I just sometimes find humor is kind of the best way to bring something like that in. And sometimes you wind up getting into, clients who are thinking about being charitable, but really aren't sure how to do it. So it's some of it's being creative. Some people want to be charitably, they are charitably inclined, but they have a little bit of a fear of writing a large check today. So, maybe changing a beneficiary is a very easy thing to do after the fact.
Well, and then one of the things too, just from a charitable standpoint, I always try to advise clients on the estate planning side is that, you know, if your children or grandchildren, if you gave away 10% of your wealth to charity, would they notice it? Would it really affect their life? And almost universally, the answer to that question is no, it wouldn't. I always try to advise clients to kind of think about it in that perspective. If you gave away a percentage, whatever that percentage is, would it really affect your children?
Sure.
So there is a question in the group chat of how you can set up a donor advised fund at the Catholic Foundation. And I'm happy to talk about that. So simply, you can use a variety of assets, whether it be cash or appreciated stock or other, as Brent mentioned earlier, you know, collectibles or other types of assets, a business. There are various ways that you can utilize your assets to start a donor advised fund at the Catholic Foundation. It's a simple 3-4 page document agreement, and simply, you know, you sign the agreement, and we have an online portal where you have access to your donor advised fund, and you can submit your grant request via the portal. You can also submit it via a form that we have at the Catholic Foundation, either way. To start a donor advised fund, the minimum at this time is $15,000 to start a donor advised fund. And we then send the grants to the charitable organizations after a screening has taken place internally from our grants department. And again, the screening is just to ensure that they are, in fact, a 501c3 charitable organization, and that they're that this organization matches our Catholic values, so Catholic teachings. And so we send the grant onto the organization, and also CC, you know, the donor of this transaction. Nancy, would you have anything else to add?
Well, I was thinking about adding something about the way we've seen some donors do something where they start a fund now, whether it's a donor advised fund or endowment fund, and then they kind of complete it with their estate gift. And I'm wondering if any of the speakers have had experience with clients and how they do something now for the tax benefits now, and then they do something in their estate plan for some of those tax benefits later. And of course, they have charitable intent all around for all of that.
I would say I have certainly seen that you know, people who have set up either with the Catholic Foundation or any or other community foundations in Atlanta who have set up endowment funds for a particular purpose, and kind of seeded the fund initially, but the large amount of the gift will be coming at their death. I've had a number of clients who've had, who quite honestly didn't even know about the Catholic Foundation, who are Catholics who want to leave significant amounts of money to their parishes. And I usually try to advise them that to leave it to the endowment fund, because that is a particular type of gift that lasts forever. And that the principal will not be spent, that it's only the income from those funds. And I find that clients really appreciate that over the years when I've talked to them about that. So, but certainly I've seen people seed a fund, but the substantial portion of the fund will not come until death.
I've also seen it where you give some control or decision making to the ultimate beneficiaries, especially for those you know, parents who may want to instill giving into future generations, where they say, here's the money, you know, you guys get to decide who gets it, so that you start that habit in the younger generations.
I agree with that. I've drafted wills that have done that before.
Yeah, I've had clients do something similar. You know, like Brent said, you kind of seed the fund with an initial charitable gift. You know, maybe someone bunches a gift to start it off, and then the remainder of the gift comes, whether it be through a life insurance policy or an IRA beneficiary or something to that effect, and then that using a donor advised fund, and then naming their children as the future decision makers on where the grants go, to encourage the charitable giving in the next generation. You're muted.
I was saying we see that too. And, you know, our fund sizes range from, it's 5,000 to start an endowment, 15,000 to start a donor advised fund. The largest donor advised fund we've received thus far, it was 5.6 million. The largest gift that we've received was 7.6 million, and it came from a charitable remainder trust. And it established the Conrad's Family Education Fund, which is now an 11-something million dollar fund, and it's given out $2 million in total to Catholic schools since we got it about 10 years ago. So, so we work with the wide range of donors and what their particular needs are in terms of giving.
Thank you. Alan, there's a question for you. Can you split an insurance gift, i.e. give some to charity and some to children? If you could speak to that, please.
Sure. Yes, you can. Most insurance policies, and I say most insurance policies that I've seen, will allow you to break down the beneficiary between break it between multiple beneficiaries. I have an insurance policy that today is, my wife is the primary, but if then it goes to half my son, half to a charitable board that I sit on. So most insurance policies will allow you to do that, but definitely check before you with the particular carrier.
Thank you.
I'm wondering if anyone wants to speak to how the insurance policy works when it's donated to the foundation, and then the premiums are paid as a tax-deductible gift. Can anyone speak to that?
I can't touch the tax treatment of that.
Yeah, I mean, I can speak to that. I can speak to that generally.
We have a few instances of this, and it may be something that can interest people.
Yeah, so I know there have been several people or a couple of policies anyway, that have been donated to the Catholic Foundation, and then the individual that donated those policies will make a donation for the insurance premium every year to the foundation, and then the foundation, I believe, pays the premium with that donation. So you get the charitable donation as you make the premium payment every year, and to the extent, I guess, there's cash value in some of those policies, you might get a tax. You get a tax deduction for that portion too, of what was donated, the cash value portion of the policy that was donated.
We have one person who's also using a company match to help cover the cost of the premium, and then there's certain endowment funds that are beneficiaries for when she passes away. It's an interesting arrangement. Any other questions that people might have?
There aren't any other questions. I have put our contact information up on this last slide. All three of us are happy. If there are any questions offline that people want to ask, feel free to pick up the phone, call us, email us. We'll be happy to answer any questions.
And I would just like to thank our speakers who put in the time along with Juliet Greco to create this valuable webinar, Brent Herron, Alan Connor, and Saber Linehan. And I also want to thank the board members of the Catholic Foundation who are the leadership team of the Professional Advisors Network, Brent Herron, John Rapole, Jody Foster, and Bill Allen. And if you have not already joined our Professional Advisors Network, you can go on our website and join. And that way you'll make sure you get invited to any future events. We will be holding another investment forum in the new year. It'll be later than the one we did last year. So it'll probably be towards end of February, early March, and we'll be getting that information out to you. And it will be a webinar, not an in-person one like we did last year. So I hope that you all have a holy and healthy Advent and a blessed Christmas. And we're very grateful that you joined us today. Thank you. Bye, everyone.
Thank you.
Have a
Thank you.
blessed day.